Hi, and welcome to Three Questions with. Got my friend Colby Doody with us from Landmark Financial. Colby, good afternoon. Welcome to the show.
Thank you once again for having me. Always is a pleasure as usual.
Cool. So I just have a couple random questions today. Can you talk to me about 1099Ks? What are they?
Yeah, so a 1099K is a tax document or form that you will receive usually in January, and it's issued by merchant service providers. And I'll give you, two brief examples. So PayPal. If you operate a business and you receive payment through PayPal, you'll get a 1099K usually. Some other ones, Stripe. A lot of people use Stripe to process payments. Venmo, Cash App, which are two up and coming, very common payment processors, basically because their fees tend to be a little bit cheaper. We're seeing a lot of those. But it will be a document that you receive in January if you have received any type of business payment. And I will elaborate more on that as we go through the conversation.
So, Colby, the next thing that always surprises me, we're coming into the end of the year. People don't ever take the time to think about end of year tax projections. I've had friends that have had amazing years. Oh my God, Kev, I doubled my income this year. And then they forget to put money aside for taxes. They get to you and you're like, Kev, great job this year, but you owe X thousands of dollars. Like, Colby, I don't have X thousands of dollars. I spent it. That's important to project, right?
Yeah, so you pretty much nailed the head right on the coffin. The whole point of a tax projection is to really get ahead of the curve. We don't want you to pay interest or penalties either, but predominantly we want to avoid the conversation in April of telling clients, just like you mentioned, hey, you don't only owe money, you owe a lot of money. So that's just the likelihood that you're going to owe is probably high, but let's, instead of waiting until the last second, let's get ahead of that, make an estimated tax projection in Q4. So that way the likelihood of you owing, it's still there regardless, but you can curb the interest and penalties that can be associated with that payment as well. So we always recommend a tax projection typically by the end of the year, as close as we can to December, so that way we can get as accurate as possible.
So, Colby, I got one more question for you. I'm a little embarrassed. I don't know what employee retention credits are, but I seem to get an email every day about employee retention credits. You got to admit, I don't know what they are. Can you tell us what they are and what I should be doing about it?
Yeah, so I'm going to talk quite a bit on this. So the employee retention credit came out as part of the COVID provisions that Congress has passed. Basically, in a nutshell, you qualify for the employee retention credit on basic terms if one, the government required you to shut down or reduce your capacity. And then two, if the government didn't require you to shut down, but your sales compared to 2019 for 2020 credit, or for prior year quarters in 2021. So for an example, if your quarter, if Q4 in 2020 compared to 2019 was lower in regards to sales, you could qualify in Q1 of 2021. So there's a lot, I don't want to say there's a lot of ways to qualify, but there's a lot involved in regards to calculating what the credit will be. And if you're going to use the sales method, as opposed to saying, okay, yeah, we were shut down either partially in full by a government mandate. If you're going to use the sales, you got to do a little bit of extra work to get in regards to what the credit is for.
But this sounds like something you really want to use someone like you for. It just seems like if you don't understand the law, you might mess it up.
Yeah, so there's quite a bit involved, mainly because two things. If you get the PPP grant, or what was a loan originally, but ended up being a grant because it was forgivable in most cases, for most companies it was, and you use those funds to pay for payroll, and you told the SBA, hey, I want my grant forgiven because I used it for wages, you cannot in turn use those same wages for the employee retention credit. So you can't double dip. So you can't take both. You are eligible if you have a PPP loan. Originally, you couldn't qualify for the ERTC, but since then, Congress basically says, okay, you know what, we'll allow you to qualify. You just can't use the same wages for both the PPP grant or the loan and the ERTC. So that's number one. Number two is if you are a shareholder. So keep in mind, this is wages only. If you are self-employed or a partner in a partnership, you do not qualify. So this would be wages only. So if you are a S Corp shareholder and you're the only employee as the owner, and you have, and I say this and I get a lot of, you got to be kidding me, right? But this is really what it comes down to. If you have any living relatives as a single shareholder in an S Corp, you do not qualify for the ERTC.
Why is that? How does the relatives factor in?
So on a high level, without getting into the complicated tax code that Congress likes to do to us, Congress said, okay, we're going to give you a break if you pay all your other employees that are not related to you, including yourself. Yeah. We're not going to give you a break if you're the only one in the company. So if you have other employees that are generally not related to you, and it goes from spouse to stepchildren to cousins to nephew, basically anyone, you got to be the only one alive on earth. And I say that jokingly, but that's the way that the law was written. You cannot qualify for that credit. Now, there are some exceptions to that. Really, there's only one exception, to where a husband and wife are joint owners of they're 50-50, 49 or 40-60, whatever the percentage may be. There is one scenario where the spouse or the majority shareholder could qualify. But again, if you have any living relatives other than your spouse in this scenario, you're probably not going to qualify for it.
Crazy.
And the reason why I wanted to talk about this today is, one, the credit is not as cut and dry as a lot of people think it is, or maybe it even should be. It is very complicated. And I get it. The IRS wants to help more than just the owners, because if you think about it, the owners qualify for PPP. So they could use that to pay themselves, and that loan was forgiven. So I get the concept behind the ERTC, but it's not cut and dry. And unfortunately, there are some companies out there that I think are taking advantage of this opportunity to make money off clients. And they are, they're advertising probably everything properly, but when it comes down to actually being eligible for the credit itself, my guess is, and based on what I've seen, is a lot of companies are not eligible, or they're double dipping and taking the ERTC on wages that were covered by the PPP loan. And you can't do that. And the IRS is starting to crack down on both PPP fraud and ERTC fraud. So there's two points I want your audience to take from this. One, if you think you're eligible, or you have employees and you haven't taken an ERTC since 2020, 2021, give me a call, because most likely in some way you either were shut down for a short amount of time, either full or impartial, or your sales decreased because there was a supply chain shortage. So if you sold any type of goods, the likelihood that your sales goes down because your AR goes down, it's really high. So that's number one. Number two is, if a company has reached out to you and they're promising you the world and you got the PPP, I would highly caution that you do a little bit of background on the company and who you're working with at that company. Are they expertise? Do they do taxes? Are they a CPA? Are they an enrolled agent? Something that can back, like a credential that can give them a little bit more credibility. You don't have to be a CPA or an EA to do this credit. However, if you are credentialed, the likelihood, this person has a lot to lose if they're going to, file a fraudulent claim. So I ask your audience to do a little bit of due diligence. If a company has reached out to you and say, hey, we notice you have employees, we can save you $26,000 per employee since 2020. Just be cautious, do your background checks, do your due diligence, and then take it from there.
So Colby, what's the best way for people to reach out to you? How can they learn more, my friend?
Yeah, so they can call the office. I'm here 5 days a week. I do not work from home. Unfortunately, my brain doesn't have that capability. So they can reach out to me at 978-984-5425.
Colby, appreciate you taking a few minutes to come into the show. And as always, thanks for meeting my friend.
Awesome. Thank you very much for having me.